Is the stock market overvalued? This is a question I'm getting from a lot of amateurs or people who are just newer to the markets. And the answer to this question is not as simple as it seems. Yes, the stock market is overvalued, but before you click off this video, it's not the right question to be asking. Rather, the right question that institutional money managers like to ask is, based off of what the economy is doing, what will be the policymakers' reaction to that? And based off of that, what will the market participants' reaction be to that? And how will that affect liquidity and positioning? And then finally, how can I come up with a profitable trade idea based off of that? So you need to understand all those things. Also, with what policymakers do, they affect the dollar. The dollar is the denominator. What I mean by that is everything is priced in the dollar. So the stock market can be overvalued, but the dollar can be even more overvalued. And if the dollar is even more overvalued than the stock market, then it doesn't matter that the stock market is overvalued. So you got to look at things on that relative basis with the denominator taken into account. And many people would just look at the stock market and just look at valuations and not look at anything else. And so you have to start including those things. And so in this video, I do want to go over some history inside the dollar and the history of the Federal Reserve to get us talking about what policymakers are going to do or what they have already started doing. And then I want to talk about what market participants are going to do to react to that. And market participants would include institutional money managers, and you can try and get in before they get in. And then after that, we got to talk about liquidity and positioning, and then how that really leads to our trade idea. And I want to go over 5 asset classes: crypto, equities, commodities, fixed income, and foreign exchange. And I want to go over what's going to happen to each and every one of them and how this will change the trading environment, because trading in a high inflation environment is a lot more difficult. And of course, when I just said high inflation environment, I'm starting to give away what my expectations are over the next decade. And remember, the next decade is a great multi-generational opportunity. It can make or break you financially, I believe. So let's start off with some basic history, because the main thing right here, the first series, out of all the series of questions, the first question you got to ask yourself is, what will policymakers do in reaction to what is happening in the economy? So we already know what's happening in the economy. The market does. Every market participant knows this. So that really doesn't matter right there. It doesn't really matter what's happening in the economy, rather the policy reaction to that can completely change it on a 180 scale. So the policy reaction, well, let's go back in history and see what policy reactions have been before. If we go back to the Great Depression with Hoover and with FDR, what we saw with Bretton Woods, and even before that when Hoover was president, we saw that what the politically expedient thing to do was not economically the right thing to do. Economically, the right thing to do was the wrong thing to do politically, and the politically expedient thing to do was completely the wrong thing to do economically. And we got to remember that, because that stretches out throughout the late 40s, early 50s, when we had 20% inflation. And then once again, in the late 60s, when inflation started to return, many people in government didn't care. Many people in government would make up excuses that at the time had seemed like good excuses. So they would say, we're in Vietnam, we have this going on, we have that going on. It's not a problem we can solve right now. It's a similar excuse to what they're making right now. Oh, we have COVID-19 going on, many people are unemployed. We just can't handle that problem right now. We'll push it on, we'll worry about it later. We'll raise rates eventually, right? They push the problem forward. Because if you want to get reelected, you can't do such things, because it's essentially a situation where you have short-term gain for long-term pain. So politicians will do something that's politically expedient, so they have some short-term gain, but overall it's long-term pain for the economy. And they will make up an excuse that seems fine at the time to most people as to why you shouldn't do that. And of course we had that in the late 60s, and then in 1971, I believe, in 1970 or 1971, I'm going to have to check my timeline once again on that, we had Nixon remove us from the gold standard. And at the time, of course, said it was temporary, but they always say that it's temporary. Just like how the Fed comes out and said that rates aren't going lower, even though just a couple of months later they go lower, or there's not going to be a crash, and then there's a crash, or such things like that. But he said he was removing us off the gold standard, and he had really 3 choices. The situation that was happening was that we had gold up here, then we had a dollar down here. And you could either do a couple of things. You could inflate the dollar because gold was artificially undervalued. So you can inflate the dollar, and that's one of the things you could do. The other thing you could do was deflate the dollar down so it got to the price of gold. So you either took the dollar up to the price of gold with inflation, or you brought gold down to the price of the dollar with deflation. The third thing, which was economically the worst thing to do, was to completely decouple it altogether. Was to take the gold standard under Bretton Woods and take the US dollar, which were connected, and to completely decouple it. That was economically the worst thing to do. But deflation is very politically wrong. It doesn't work to get reelected. And you know this if you talk with voters, because voters are very short-term oriented. So you can't get reelected with that. And the inflation, although you could do it, and they tried in the beginning actually to do that, there was just so much inflation that was needed. So ultimately, he just said we're going to decouple it. That is politically the easiest thing to do, and that is the easiest thing to do short term. But long term, though, the 1970s had 15, 16, 17% inflation throughout the 1970s, and it was one of the worst decades when we look at it from the perspective of real stock market returns and such, where in real terms the stock market lost 75, 80% plus. So from that perspective, it was absolutely terrible. But again, going back, I just want to get that point across that the politically expedient thing is not the economically healthy thing. And then we saw this later on. In the 90s, there was a lowering of rates, and then we saw the dot-com bubble start. And then the dot-com bubble happened, and then it cracked as soon as rates started to spike up. The dot-com bubble cracked, and it all fell. And we saw this with the housing bubble once again, with federal funds rates at 1%, and the housing bubble happened, and then we saw it all collapse after they started to raise rates. This time around, though, something different's happening. They lowered the rates, they raised the rates a little bit, but then as soon as the stock market just started to crash, instead of letting it crash in Q4 of 2018, they stopped cutting rates, and every time the stock market tried to crash, they lowered rates to bring it higher and higher. This is very inflationary, actually, and many people are not understanding this. Because many people are looking at this, they're saying the stock market is overvalued, and it is. In real terms, the stock market should drop 80 or 90%. But that doesn't matter. When the denominator, the US dollar, is more overvalued than the asset you are comparing it to, then that doesn't matter at all. And so because of that, we're in a situation right now where the US dollar is overvalued because of what is going on with monetary policy. The number one thing people are going to say to this, though, is that in 2009, 2010, 2011, we had things like ZIRP, which is just a zero interest rate policy. We had quantitative easing, 1, 2, and 3. We had lots of fiscal stimulus with lots of bailouts. So why didn't we get that high inflation that time? And here's the analogy I use for that. Imagine you have $100, and you take the $100 and you're just circulating it in the real economy. And then you print another $100, and this time you still take the $100 and you circulate it in the real economy, but then you take the other $100 and you stick it under your bed, and you never take the other $100 that's stuck under your bed and circulate it in the real economy. Well, there is 100% inflation because you went from $100 to $200 now. So each dollar should, because of the increase in money supply, be worth half as less. But, the problem with this is that even though it should be worth half as less, you're in a situation where the money is not going into the real economy. This is similar to what we had. You had the money being printed and the money supply increasing, but it's like you took the extra $100 and you just stuck it under your bed and you never let it into the real economy. So you have the real economy right here, and then you just stuck the $100 under your bed, and the other $100 are in the real economy, but you don't see any more money supply in the real economy. It's just all right there under the bed. And the problem comes, though, as soon as you take the $100 that are under your bed, and then you start adding it into the real economy. And once you add it into the real economy now is $200 circulating, and so now you can actually feel the effects of inflation. Now, this is what the hyperinflationists got wrong in 2010, and 2011, when they were saying that there was going to be hyperinflation, and they are early, there will be, at some point hyperinflation, but they were early because they didn't understand how the money was actually getting into the system. If you just have higher money supply, although that in and of itself is not a good thing, higher money supply needs to come with higher velocity money. You need to see higher money supply and higher velocity money, and the two need to come together. If I simply just printed extra money, but I never actually circulated the extra money into the real economy, so I have the real economy and then I had the extra money, but then I kept the extra money in the banking system with the Treasury, with the Fed, with what went on Wall Street, but I never let it into the real economy, then it doesn't matter. It doesn't create inflation. I can print as much money as I want. If I have $100 right here in the real economy, I can print another 1,000, 10,000, 100,000, million in, as I said, under my bed, which was just, of course, the analogy I was giving. But I can print as much money as I want, and I can have as high of an M2 money supply as I want. If that money is not coming into the real economy, then it doesn't mean anything. And that is a major thing you have to remember, is that the money has to be traveling from one area to another. It has to be circulating around, and it cannot just stay in one area. So if all the money is trapped in the banking sector, it doesn't create inflation if it does not come into the consumer price asset areas. So if it does not come into the commodity areas and consumer price areas, then it does not create consumer price inflation. So you got to have the money starting to come into the real economy. And that is the key right there, is that over the last few years, we have had all this quantitative easing, and it's actually been very deflationary because the $100 has just been stuck under the bed, like I said with the analogy, and it's been inside, they're rotating inside the system under the bed, and the system under the bed is completely different than the system outside in the real economy. So it's like you're printing more and more money, but you're stuffing it under the bed, you're stuffing it in the repo market, you're just keeping it in the banking system. It's all in the Treasury, repo market, areas on Wall Street that are connected to the Federal Reserve. And it's all down there. The economy outside, the real economy, is not getting connected to that money. And so you gotta ask yourself, what is the catalyst to create that? What is the situation that we're gonna get where we actually get a situation where the money that is down there in the that's going on in the repo markets, quantitative easing over there, quantitative easing in areas like junk bonds, corporate debt, other areas of debt monetization, all this other stuff, when does that mix into the real economy? And the answer to that would be, first off, you need a catalyst. So you need a catalyst for something further to happen. Personally, the catalyst, I think, is going to be the second wave of coronavirus. Although this catalyst can be anything. Just remember, coronavirus is simply the pin that pricked the bubble. It is this catalyst that came out that pricked this larger financial bubble. So you already had a financial bubble. Coronavirus just created a catalyst for this financial bubble to actually pop and burst. And so you really got to ask yourself, what's going to be that catalyst? And it can be an election, like Joe Biden getting elected. It can be the second wave of coronavirus. There's so many different things that can actually act as a catalyst. And so all you need is a catalyst. And then afterwards, policymakers will react to this catalyst. So how will policymakers react to the catalyst? I don't know what they're going to call it. They always come with a different name, right? First it was debt monetization, that was quantitative easing. Then they came up with a different name in September 2019 when they started quantitative easing 4, but they didn't call it that. So they always come up with different names and such. But it's really the same concept at the end of the day. You have a situation where they're going to implement something like universal basic income. The first problem with the stimulus check was that everybody saved the money. Everybody took the money and then they saved it. Nobody took that money and invested it. Nobody took the money and spent it. And that's the important thing. Nobody took the stimulus check and spent it, because the stimulus check was so small that it was enough for you to live off of, but not enough for you to spend. But now what if you got a stimulus check every single year guaranteed by the government that is $50,000? Or every single month you're getting $1,000 or $2,000 or $3,000 from the government. Well, now you have enough money to pay off debt. Now you have enough money to save, but now you got a bunch more money, and maybe you'll invest some of it, but then what are you going to do with the rest of it? Well, you're going to take the rest of that money and you're going to spend it. And that is the key. You start taking the money right there from the system that comes from the Federal Reserve, that comes from the Treasury, and you take that money from whatever they're going to call it. They might call it UBI, they might call it stimulus checks, whatever they want to call it. You're going to take that money and then you're going to spend it into the real economy. That is what triggers the higher velocity of money right there. And so far, all these years, we have had higher money supply, but the money is not getting into the real economy. The money is going to the stock market, into the bond market. It's creating bubbles over there. But the money is not getting into other areas of the economy and creating consumer price inflation. The big catalyst for that can be something like the second wave coronavirus, to create a situation where policymakers react to that and then implement something along the lines of UBI. It doesn't necessarily need to be UBI. It doesn't need to be large stimulus checks. It can be some sort of a bailout, clearing student loan debt, anything along those sorts of lines. Essentially just giving people more money to spend. It could also be something along the lines of Medicare for all, some other welfare programs, creating a situation where they, instead of taking the money that should be, instead of taking Social Security money and then paying Social Security, they instead actually add on to it because they want to increase spending. So then people instead take that money, where people get more Social Security money, and you might say, how does that happen? Don't you have to pay into that to get more money out of it? Well, not really. They can go and they can create a higher money supply, and they can just put in things like Social Security, put in things like stimulus checks, put in things like food stamps, and actually give people higher amounts for unemployment. Right now, they're giving people so much money for unemployment that they are making more from being unemployed than they actually are from working. Well, what if we took that situation to the next level? Because that's how policymakers react. They react with short-term gains. So, of course, if I got a bunch of money, if I got $30,000 a year extra, that is a short-term gain. But, of course, we know that has long-term economic pain because that money is not free. There is no free lunch. But politicians and policymakers care about that short-term gain, not the long-term pain. And they always react to everything by throwing the kitchen sink at it and by doing whatever it takes. And so because of that, you're going to have that situation where UBI or stimulus checks or some sort of welfare, something along those lines, where they try and pump money in there through fiscal and monetary stimulus to everybody, and then everybody starts spending the money in the real economy, and it creates that situation where the inflation starts to rise, and where we have the situation that I said with the analogy where you have the real economy and then you have the money that you just took, the money that you printed and you took, but you just stuffed under your bed. You never really took it out of your bed and spent in the real economy. Well, once you start spending that money in the real economy, then the money supply in the real economy starts to change. So you took high M2 and you combined it with high velocity, combine the two together, it ultimately leads to stagflation. And combine that, of course, with bad economic fundamentals. So that's the first thing right there, is that eventually does lead to very high inflation. And seeing what policymakers usually do, which is that they react very late to things. They wait until the problem gets so bad that voters and constituents start to complain about the problem, and that people on Wall Street might start to complain about the problem. Only then will they start to solve the problem. So you can have a situation where you get 15, 20% inflation, 30% inflation, then they finally start to solve the problem. Or maybe even at that situation, it's not even bad enough at that point for them to solve the problem, because we're also in a situation, you got to remember, where we have a lot of debt. Debt is just future money that you have to pay back. Well, if in the future the money is worth a lot less, then you're going to have to pay back less debt. And so they're actually incentivized to create higher inflation. And so based off the incentive structure and based off of how historically policymakers tend to react with things that are politically expedient, and how the voter base and constituents tend to be very short-term, tend to have a very short-term mindset where they look for short-term gains even if there is long-term pain. Based off of all that, it's going to lead to higher inflation. So you know that off the get-go. What happens on the way that we get there? We get deflation first, and it's going to be very mild deflation. It's going to be short-term mild deflation. As I said, they always react after the fact. So if it takes another year for the second wave of coronavirus to play out, they don't react to the second wave of coronavirus until after the fact, until after it's gotten so bad. So it might take them a year or 2 years to implement what I said, like universal basic income or stimulus checks or extra welfare. It might take them a year or two to actually start implementing these things. And if it takes them a year or two to start implementing it, what's going to happen for that year or two? And if you don't do anything, if policymakers did nothing, then we would have massive deflation. But it's because the policymakers do something that we instead turn to hyperinflation. But it's going to take a while for them to actually do something because they lag behind the economics. Policymakers will wait for something to play out, like with coronavirus. They waited for it to get bad enough after months and months, and then finally they did something, and then they try to get rid of it as quick as possible, and just made the situation worse. And so they always lag the economy. Policymakers will always do something after the fact. And so what's going to happen for the next 6 to 18 months? I think that the dollar rises for the next 6 to 18 months, that people go to the dollar for liquidity. So shorter term, very mild deflation. We're talking 0% to negative 2% inflation, so 2% deflation. I think that's really the highest or lowest. That's the lowest negative inflation. The highest deflation we really get is negative 2% inflation. But still, we're going to get there. And I think that we see one last push in the dollar. And in dollar cycles, we're getting to the point where we're getting to something called a napalm run, where there's a big liquidity crisis. And we did see part of this in March, but it didn't completely play out. I think we will see a situation where everything sells off and people have to pay back debt and they create demand for dollars and people start running to cash for liquidity and short-term T-bills and they start selling off things on the long end of the curve. And so you see this sort of a situation, and you see the dollar for a very short period of time. It's going to be very short for a short period of time, but you do see the dollar index go higher. So shorter term, you will see this napalm run, as we call it, in the dollar. Some people think it's going to last years. I think that policymakers step in before then. So policymakers step in late, but they don't step in that late. Policymakers with coronavirus waited months until they stepped in. And so I don't think they're going to wait that long. I think that 6 to 18 months is an appropriate time frame. They won't wait more than 18 months, though, to start implementing many of these policies because, of course, at that point, constituents and other market participants are going to want these policies. So that's what's going to happen right there. You see short-term deflation. In the short term, yes, you see this big rise in the dollar with a napalm run, as it's called by many people, over the next 6 to 18 months, but overall, longer term, it leads to the dollar really dying out and the dollar going lower against other fiat currencies, although I believe all fiat will follow along and will eventually end lower. It's just that the dollar faces the worst situation, and that dollar being the world reserve currency, what tends to happen is that world reserve currencies tend to abuse their power. So if I'm a world reserve currency, I'm going to abuse my power, and so it creates a situation where you actually get higher inflation in the dollar. And so the US dollar is able to stay afloat longer inside a bubble and is able to stay more overvalued for longer periods of time, like decades, because it's a world reserve currency. But when that bubble pops, it's going to pop in a big way because it is a world reserve currency, because it's abused its power so much. So now the question gets to, how is this an actionable trade idea? So we looked at what policymakers will do based off of what will happen in the economy, and we know that the market is definitely overvalued, 70, 80, 90%, right? Or it's going to go down in real terms, 70, 80, 90%. And we know that, or for those of you who don't know actually, V-shaped recoveries in unemployment usually actually take 2 years. So even with the V-shaped recovery, it's going to take 2 years. And we're in a situation where we have, if you believe the unemployment numbers, World War II type unemployment. If you don't, worse than Great Depression type unemployment. So either way, we have really bad unemployment. So it definitely likely won't be V-shaped. It's likely going to be U or W-shaped, 4 to 5 years. Although some people will go as far as saying it's going to be L-shaped. But either way, on all metrics, even if it's V-shaped, which is very, very unlikely to be, the market's overvalued, and it was overvalued before coronavirus. I mean, coronavirus was simply that catalyst that pricked that bubble, but it was overvalued before then, even though coronavirus was just a pin that pricked it. And so, remembering that, we have to look at what market participants will do and how they will use positioning and liquidity, because that's ultimately where we want to go. We want to get there before everybody else starts getting there. And so knowing the main 5 asset classes that I talked about that are fairly liquid, that most people have access to. Those are 5 asset classes that pretty much everybody has access to, including institutional investors, including you and I. Everybody really has access to that sort of stuff. And so those 5 are the ones that I want to go over right there, because we want to follow the money. We want to get there before the institutional money gets there. We want to get there before these very long-term pension funds, these long-term long-only funds, long-term mutual funds start to get there. And so we might have a situation where the hedge funds get there, but the hedge funds are shorter term, usually long short equity, 1 to 3 month type time frames. But we want to get there before the longer term guys like the pension funds, sovereign wealth funds, long only funds, mutual funds start to get there. And so we want to allocate to that before other market participants start taking their positioning and liquidity to other areas. And based off that, we will make our trade idea. So the 5 asset classes. First, I want to talk about crypto because I know many people are going to bring that one up. I got a couple of problems with crypto. First off, it's a very small marketplace, not as liquid, doesn't have a liquid exchange. But that's a problem that can be solved. So if there is a large demand for crypto, then that problem can be solved. So I'm not too worried about that. The problem that I find with cryptocurrencies longer term is that, first off, they don't have any intrinsic value. Things like gold or silver can be used in electronics, dentistry, jewelry, many different things like that. Crypto doesn't actually have a real use outside of what people will be using it for, which is largely transacting or speculating. And so it doesn't really have that intrinsic value use right there. And an even larger problem, regardless of that, though, that the same argument can be made for the dollar, and of course that's why longer term people are dollar bearish. Even the people who are short term dollar bullish for the next 5, 6, 7 years, they are very long term, though, dollar bearish because they understand that ultimately it's not backed by anything. And we know about all fiat currencies. But the biggest thing is that we got to remember that policymakers, again, what policymakers are going to do is that they will likely try and do whatever it takes to try to ban cryptocurrencies. Just like in the 1930s when they banned gold, they will likely come and ban cryptocurrencies. They will do whatever it takes and say no more transaction with cryptocurrencies like they did with gold. And really all you could do with your gold in the 1930s was try and store it in your own home where where law enforcement would not be able to find it. And so if law enforcement can't find it, you can't get in trouble for it. But what's the point of having an asset if you can't even transact in it? And at that point, it's not even liquid. And at that point, pension funds and mutual funds and long-only funds and sovereign wealth funds can't put money in that asset if it's illegal. So really, the political risk is the largest in cryptocurrencies. So that's the problem I found in crypto. I do have to say, out of all the 5 asset classes that I'm mentioning, crypto is the one that I know least about. So just keep that in mind if you disagree with my viewpoint on that. The next one is bonds. So bonds, of course, you're not going to go long bonds because if you go long bonds, you're going to lose money because of inflation. All a bond is, that's a future. It's a future obligation on money. So if I loan you out money, you're going to give me the money back 5 years from now, or 10 years from now, 30 years from now, whatever it may be. It's just future money. That's all it is. Well, if the money's going to be worth less, you don't want to go to bonds. But what about short bonds? Many people start saying. The Fed, though, what the Fed's going to start doing is that the Fed is going to start backstopping everything. They will start buying up the bonds, and they already have with the QE Infinity and the QE4 programs that they're doing, where they're going to start buying up those bonds as quick as possible and trying to backstop the bond market and put a high yield or a high yield ceiling on the bond market where yields can't go above a certain amount. And so, yes, you could hypothetically short the bond, but you're not going to make money. The reason you're not going to make money is because the Fed will not let yields go higher, and they've already said that they will do some form of yield curve control, and we've already seen the negative effects of that. There's basically, in places like Japan where they do complete yield curve control, the only person who is buying bonds or who is even participating, or the only institution rather, who is participating in the bond market is the Bank of Japan. Nobody wants to get into the bond market. Nobody buys bonds, nobody shorts bonds, nobody does anything with bonds. And there's zero liquidity in the bond market. And every time there's a bond auction in Japan, the only one who ends up buying those bonds are the Japanese, is the Central Bank of Japan, the BOJ. And so that's how bad it can get. Zero liquidity, and if you buy the bonds, you lose money because of the inflation. If you short the bonds, you lose money because they're going to start doing yield curve control, and they're going to control and peg every single part of the yield. So the Fed's going to come out and say the 10-year is going to be at 0%. The 2-year is going to be at negative 1%. The 30-year will be at 2%. And they will peg every single part of that yield curve. And so yields cannot go up, and since yields trade inverse to bonds, you can't make money shorting it. So basically, you don't make money going long because of inflation. You don't make money going short because of what the Fed's doing. So either way, you cannot make money. It's an illiquid market where you cannot make any money. And just look at what's happened with Japan and the yield control over there, and how the Bank of Japan is the only market participant. There is zero there is zero market participation from private institutions too. Also, before I get into my next asset class, I forgot to mention this. It's a little something that I was thinking about related to this, and that is how will things go private versus public? So what I mean by that is many people will buy a government bond and they will say this bond is really safe because it's from the government, it's from the public sector, or this bond is not as safe because it's a junk bond, it's from a private company. I think we do see a turnaround in that, like we did in the 1970s, where people will actually not buy government bonds. They'll say, oh, if I buy the government bond, I'm going to be in a situation where I'm going to have inflation risk, all that risk that I don't want. I don't want to buy anything from the government. I don't want to buy municipal debt or anything like that. But they're going to be fine with buying equities and buying into private companies because they trust the private companies more. And I think we do get that flip in the spectrum where the 180 flip where people start to trust government less and they start to trust private institutions more because at least the private institutions do not have the same sort of risk that the government does because people think about T-bills as very risk-free. They think about that as a risk-free rate, but they don't take into account the massive inflation risk that's there, where historically we have in the past had situations where you go from 1 to 20% unemployment like that. So moving back onto bonds, I just want to talk about that because that's a little something I forgot to talk about, but I do believe we see a spectrum shift where people start trusting private institutions more and start trusting the government even less than they do already, which is the amount that people trust the government is already very small. So talking about bonds again, in the late 40s, early 50s, when we had massive inflation, the Federal Reserve did yield curve control. And if you would have bought a treasury, you had treasury paper trading for 1% yields, but you had inflation at 19%. That means that you had 18% basically of a loss. So right now, if you thought the negative rates are bad enough where you're losing a couple of basis points, maybe you're losing 1%, 2%, right? Think about losing 18% in a year. So a fifth of your money is lost every single year. That's basically what happens with bonds. And so if you're long that bond, you're going to lose that much. But if you're short the bond isn't even moving because of what's going on with yield curve control. The whole yield curve will be controlled. So fixed income is not a good place to put your money. Crypto is not a good place. And I believe the fixed income, all in all, it becomes a completely illiquid market. I think that 10, 15 years from now, we're going to have a situation where the Fed is the only one who is buying bonds. Nobody else buys bonds at all. And it is a completely illiquid marketplace. And nobody wants to participate even on the short side, taking the other side of that, because they know that the Fed is backstopping it and that they're creating a negative feedback loop for the inflation, but they are backstopping the yields from going higher. Okay, so we got those two out of the way. I think those are basically the worst. The one that I think that's the worst after that is the foreign exchange market. So you might say, okay, but what about going short the dollar? I understand going long the dollar, shorter term, you might like the trade. I like the trade going long dollar. I would wait for it to go lower from here because of the technicals, but I like it shorter term, like over the next 6 to 18 months, like I said. But with foreign exchange and the dollar longer term, what's the viewpoint? Well, people are going to say, okay, but I can go long emerging market currencies. I can go long the INR, the Indian rupee. I can go long the RMB. I could go long the rand. And I could do that all against the dollar. And they will rise against the dollar, yes. But as I had said earlier, everything's going to drop. Maybe the rand drops 10%, but then the dollar drops 90%. Well, you're still going to lose money in real terms, even though in nominal terms, if you go long the South African rand, short the US dollar, or long the Indian rupee, or long the Chinese yuan, the RMB, against the US dollar, yes, you will make money in nominal terms because of the relativeness of the two, which everything has. But in real terms, you're going to lose money because all fiat currencies will go down. Some fiat currencies will just go down less than the other ones. And so that's something to remember right there. So I don't think, again, foreign exchange, I believe that's only going to be used for bona fide hedging purposes. But I believe that lots of institutional money will start to leave those markets. The liquidity starts to leave those markets. So what else do we have after that? Well, we got equities and we got commodities. I want to talk equities for a second. Equities are going to work as a long position. Of course, not as a short position because it's priced against the dollar. So you don't want to be short and hope that the dollar goes up. But equities on the long side will work with one exception. if I see that the stock market goes up 100% nominal terms, but at the same time we have 100% inflation, then it really made nothing. I made zero. Or if we have the stock market going up 50% in real terms, but then inflation is 100%, I really lost money. So you need a situation where it also goes up in real terms. So you have to find equities that trade at low valuations, equities that are in sectors like the commodities sector or that have inflation protected business models. So you need low valuations and you need inflation protected business models to ultimately help you longer term with what goes on with commodities. And so that's what you need right there, or with equities. And so equities, I do think that equities work with high inflation. It's just a harder trading environment and it will be very, very volatile. And so you probably want to overlay equities with some sort of commodity based strategy, like a CTA trend following strategy. But yes, I do believe that equities longer term are going to work. You just have to go into equities that are valued at a low valuation. So something like Japanese equities would work. Hong Kong equities, to a certain extent, they are valued cheap. American equities are not, though, which is why American equities will lose value in real terms because they're not valued that way. And so you need business models that on a relative basis, we would say, compared to inflation, they're able to essentially keep up with inflation. Something like, let me take an example like Coke or Pepsi. Coke or Pepsi are able to raise their prices. They have that pricing power where if there is high inflation, they're able to raise their prices. At the same time, you want something with a low valuation. So you need those two to come together. And then the way that I would be trading it is that it's going to be very, very volatile. So what you have to do is that you'd have to constantly rotate in and out of sectors. I believe there would be a big sector rotation. So you get into gold and silver stocks, and then you rotate out of that into ag commodity type stocks, rotate out of that into soft commodity stocks, rotate out of that into emerging markets, and so you constantly rotate. So you might have a portfolio that is 10% this, 10% that, 10% that, 10% that, and then you take a little few percent out of one, put into another, put into another, and then you rotate in and out of these on a consistent basis. You trade back and forth between them, and to reduce the volatility, then you put some sort of an overlay. Trading in a high inflation environment, especially inflation of 20, 30, 40%, where the denominator, the US dollar, is going down at such a rapid rate where everything just keeps on going higher. That's a very hard trading environment to trade in, but it's also a good opportunity. So equities, you're going to need them because you need something that's going to produce cash flow for you. And I would say that if you're able to, sector rotation works very well, and definitely equities that are valued very low, very cheap, like equities that are valued at like a PE of 5 on an overall basis, that are relatively safe, that have safe cash flows, and that are also in a situation where they have pricing power against inflation, something like Coke or Pepsi, where they can constantly raise their prices, not something where the prices have to stay stagnant, where they're going to lose money because of that inflation. So that's something you got to keep in mind right there. Although Coke and Pepsi, I do believe the valuations are still quite high. And so that's what I have to say about equities. If you're longer term and you're planning on buying and holding this longer term, you like a buy and hold for a decade, you will need equities in there just to produce cash flow. You really can't only go with commodities, but you will need equities in there. But that's the best way to go about it, and have some sort of an overlay, like go long vol, consistently buy front month vol futures, and then just roll it if it's in backwardation. Go long vol some way, or have some sort of an overlay to reduce vol. And then the next one would be commodities. And this is a sector that I like the best. And it's going to be good if you are just a short-term trader. If you're a long-term investor, though, you can only put a certain amount in there. I wouldn't put everything because it doesn't generate any cash flow. It's a depreciating asset. And when trading commodities, like I said, soft commodities like your coffees, they're down. Wheat is in a bear market, massive bear market, has been for years. Natural gas is at 25-plus year lows. Gold and silver, they are starting to recover. And I think they're the first commodities that go up and you rotate from one commodity to another on a consistent basis. Oil, I also believe longer term I'm bullish, even though short term I am not. Things like that are going to work, and you should likely use some sort of a CTA trend following strategy to trade in and around them. And the best way to trade them would be longer term time spreads. So ones where you go out, usually what you'll do with something like oil is that you will go out to December. So right now I'm recording this in 2020, July 16th of 2020. So I might go out to December of 2020 and go long an oil future, and then 2021 December, I'm going to go short an oil future, and I will play a time spread like that. And of course, I'll use some leverage on it because time spreads don't really move that much. And so you got to use that because the contango backwardation in any particular market is going to be too much. And so you got that right there. If you do have deep backwardation, though, you can just buy oil and then just roll it again and again and again. Or you can buy oil future very far out, or oil commodity or oil equities would work. But commodities, I think, will be the big one to help the most. But you got to remember, where in a long-term portfolio that you're going to hold on to for decades, commodities are simply just a hedge. They do not produce value. They are a depreciating asset. There is a cost of carry on that. And so you do have to find ways around that. And you can use different future strategies or tie in options with that too, and come up with a strategy that would work in that sort of an environment. But ultimately, going over those 5 asset classes, I'm going to say that equities with a commodity overlay, so large amounts of commodities as a hedge, with some sort of future strategy, with equities included in there, along with some sort of long volatility products, rolling VIX futures, some sort of gamma scalping where you get in and out really quickly with vol. That's harder for long-term investors to do, but long vol I think will work because vol will stay above its mean a lot more than it has in the past. And so of course, if vol is above its mean, the cost of carry to roll the volatility futures are a lot cheaper. And you don't necessarily just have to be in something like the VIX. You can try and go long vol in one market, and then after you make money there, take the profits and then rotate into another market. And rotating in and out will work pretty well. Other than that, though, that's all I have to say to wrap up, is that equities, commodities, I think, and along with long vol, those are going to work really well in a CTA trend following type system over the next decade. And I think that there will be a lot of opportunity to make and lose money, but it will be a multi-generational opportunity. And it is a hard trading environment, but if you get it right, it's a great environment. And so if you guys have any questions, go ahead inside the comments section. Just go ahead and ask whatever questions you guys may have. You guys can also find me on TradingView, and I'm also on StockTwits. And if you guys want help with shorter term trading around these longer term trends, I do have a membership for a premium where I offer daily pre-market newsletters along with trade alerts on trades that we do, and we try to make at least a 50% annualized return. Other than that, guys, if you guys have anything else, just go ahead and ask me. Stay safe, stay profitable, and happy trading, everybody.